Okay, this is a presentation to help you decide whether to get your money through a venture capital, an initial public offering, or a reverse merger. My disclaimer, it's not legal advice to anyone. Your individual situation will vary. You want to consult qualified advisors. So this compares your fundraising options: venture capital, IPO, or reverse merger. Your key questions are as follows. 1. How much money can I get? 2. What price can I get the money at? 3. How fast can I get the money? What is it going to cost me to get the money? Do I have to give up control? And how fast can I sell some stock myself? Okay, IPOs can be larger than venture rounds. IPOs can be larger than reverse merger financing. Venture capitalists want you to sell to them cheap to maximize their return on investment. Investment bankers want larger deals to make more commissions. In a reverse merger, the amount is whatever you can justify. IPOs are going to be the slowest because the underwriter has to do due diligence and you need an audit and the SEC has to approve your filing. Venture capital is going to be the fastest. I know one VC who says he will not write a check in less than 90 days, but most have no such rule. With a reverse merger, the speed depends on your due diligence of the shell company and whether or not you need an audit, and an SEC filing is needed unless you go into the pink sheets. What does it cost you? In terms of out-of-pocket upfront cash, for an IPO, you need to pay legal, accounting, and the investment banker fees. In an IPO, you're limited in raising money while you're in registration. This is an important point. You need to have enough money in the till to get through the registration process, which can take several months. You have to have this money before you start. Now, venture capital is going to be the least out-of-pocket up front. Basically, you just need to pay your lawyer. With a reverse merger, you have legal and accounting costs. It's going to be your cash costs. You're also going to have the cost of the shell, which can be in cash, and you'll have to give up some portion of the equity of your company to get into the shell. Now, what percentage of the company you have to give up? With an IPO, the investment banker has no problem with your staying in control. The percentage sold is going to be dependent on investor demand and how they value your company. Venture capitalists, however, will often want control. They tend to believe they're smarter than you are. With a reverse merger, the percentage you give up will depend on how the market views your company. You are going to keep control. How fast can you sell some of your own stock? In the IPO, the pre-IPO process will take months. The SEC approval will take months, and typically the underwriter will want to lock up your stock so you can't sell for months after the offering hits the market. The venture capitalist will not want you to sell your stock. He may even have you sign an agreement that if you find a buyer for your stock, you have to offer the buyer to the venture capitalist first. You're going to be locked into a private company. In a reverse merger, you can start selling under Rule 144 6 months after the deal. Faster if you register your stock for sale, or faster if you sell privately. Can I get more money later on? Well, underwriters may want to sell more stock for you if your deal was successful. Venture capitalists may do a new round of financing at higher values if your company is successful, but you can expect more dilution and less control. In a reverse merger, you can sell more stock when you want, but the market will limit how fast you can go back for more money. So what's the best alternative? You have to decide. How much money do you want? How fast you need it? How much you can afford in upfront cost? And how important dilution and control are to you? Now, for a free consultation, you want to call me, John Lux, 240-200-4529, or you can email me at john.lux@securitieslaw.info. Look forward to talking to you.